Good morning, everyone. I hope for this morning. My name is Bo Makombe. I'm the head of marketing and business development for Ellchart Business School, and I'd like to welcome you all to this webinar on IPSAS 45. So Ellchart Business School has established itself as a premier institution in public sector accounting, showcasing an impressive track record of success in IPSAS training and consulting. And through its partnership with the Ministry of Finance, the Institute of Chartered Accountants of Zimbabwe, which is IPSAS, and the Public Service Commission, Ellchart has been instrumental in rolling out IPSAS across Zimbabwe's public sector entities. And also, over the years, Ellchart has really made significant strides in IPSAS training, featuring comprehensive programs for public sector entities, capacity building for finance professionals, facilitators, and also just practical approaches, training approaches for all the public sector entities. So, as part of our ongoing commitment to supporting the development of a strong and transparent public sector accounting framework in Zimbabwe, Ellchart Business School is pleased to present to you this morning join us on this interactive session as we delve into the key aspects of IPSAS 45. And this morning we'll cover accounting for changes in accounting policy and estimates, accounting for revaluations, and accounting for separate components. So those are the three aspects that our speakers will delve into this morning. So allow me to introduce to you our first speaker, who is Mr. Ellis Mukunyadze, who is the co-founder of Ellchart Business School. He's also the Chief Training Officer and a well-renowned expert in the public sector accounting. He's also a chartered accountant and a registered public auditor. So Ellis brings a lot of wealth of experience to the table, especially on IPSAS issues. And he also serves as a World Bank consultant, working closely with the Ministry of Finance and Economic Development. And all this is just to implement IPSAS across the Zimbabwean government. So with his expertise and leadership, Ellchart continues to play a vital role in shaping the future of public sector accounting in the whole of Zimbabwe. So ladies and gentlemen, allow me to introduce to you Mr. Ellis Mukunyadze. Over to you, Ellis.
Okay, good morning, everyone. Extremely delighted to be doing this webinar where we're going to be focusing on IPSAS. The reason around this webinars, which will also be available through a recording so that you can always go back, is to look at some of the practical issues that are affecting a lot of people that are implementing. So today we are focusing on IPSAS 45. The objective is not to take you through the whole standards, but we've selected specific items within IPSAS 45, which we believe are very important in your implementation journey and some of the questions that we've been getting. So we take this opportunity to clarify those and work through those things together. So try to be as much practical as possible so that you've got key takeaways from this session. If you've got specific areas where you'd say, can you guys also do a webinar on this? We welcome some of those areas. It could be on any standard where you say we have got these practical challenges. Can we do a webinar on this? We'll be able to do it as we support you in the IPSAS implementation journey. So just allow me to share my screen so that I can quickly get into the presentation. Yes, so I've put in Excel so that, because we're going to be working through a couple of examples so that it's it will be as practical as possible.
Oh, sorry, I don't have the screen.
So what I want to cover, and Joseph is going to come and cover the other aspect, I'm just going to be focusing on, sometimes when you're implementing IPSAS, you're coming from different frameworks. Some are coming from cash basis, which is an accounting framework. Some are coming from IFRS, which is another accounting framework. And what happens is when you then implement IPSAS, the policies that you're applying before and the estimates that you're applying before will then change. So the objective of this session is just to demonstrate with the examples of how you account for certain changes. It could be change in policy or it could be change in estimate. And how do you, as you're applying IPSAS 33, how do you then apply those changes as it relates to IPSAS 45? So that's essentially what we're going to cover. So what is it that I'm going to cover? I'm going to look at where there's been reclassifications. In other words, from your previous basis, you'd classified a certain PP item differently than what is now required under IPSAS and also in line with the Zimbabwe Financial Reporting Framework. So I'm going to cover how do you account for those reclassifications, and we're going to do that by way of examples. Secondly, I'm also going to cover where you've got an asset which you had not previously recognized in your previous accounting framework, and you now want to bring it into IPSAS. How do you account for that asset? How do you bring it on board? Then thirdly, I'm going to look at where we are looking at where the asset was classified correctly, you had recognized it correctly, but because of the ZFRM, you have to adjust the useful life of that asset, and you also want to adjust for residual values of those assets. So what do you do in that instance? So we're going to demonstrate that as well. Then last but not least, I'm then going to look at where you have got an asset which you had not previously recognized, but now you want to recognize it, but it's already past its useful life. So this asset is still in use, but it's past its useful life. So it could be a motor vehicle. You've been using it for 10 years, whereas the useful life of motor vehicles is 5 years. How do you bring that asset into the books as you apply IPSAS? So these are the different scenarios that we are going to cover. So let's start by just way of background. IPSAS 33. I'm doing from IPSAS 33 because we're applying IPSAS 45 through the lens of IPSAS 33. So it recognized that accounting policy that as a first-time adopter you're applying may actually differ from those that you applied at the end of the previous period. And then it acknowledges that if you've got any adjustments that needs to be adjusted, you need to take those adjustments through the non-distributable reserve. So any adjustments that we have through that process of changing from the previous basis to the current basis will go through a non-distributable reserve, which is an option which is provided in the non-distributable reserves. IPSAS 33 gives options, either take it through accumulated surplus and deficit or another component of equity. We are taking it through another component of equity, which is the non-distributable reserve. So let's get into it. So I said the first thing that we want to look at is where there are reclassifications. So I'm using examples, and I hope it becomes easy for you guys to have that practical appreciation. So here we've got SOE as a property, which is being used as head office. So this property, because it's being used as head office, it's PPE. It's not investment property, it's not inventory, because the head office would typically be your PPE. So it's within the scope of IPSAS 45. So currently it's got a carrying amount of 10 million. A stand in the same area costs $75 per square meter. The property is an extensive road within it, which if it was constructed today would cost 2 million. The road was constructed 5 years ago. The size of the property is 10,000 square meters. So what you're seeing here is we have got a property that we had classified as PPE under the previous basis, but with the adoption of IPSAS and also being guided by the accounting policies in the Zimbabwe Financial Reporting Manual, the Zimbabwe Financial Reporting Manual requires us to, number one, to split land, because there is a class called land. So this property, we need to split it between the land and the building. But also, we also told that within this property, there is an extensive road. So this, again, we also need to split the road because it's another class with its infrastructure, which is infrastructure asset within this particular property. So what I want to demonstrate here is how then do you go about that sort of split? So for starters, number one, and I'm going to be using Excel here, we are saying we've got the property, and we said it's 10 million, right? We are told that if we are going to, just by surveying, land within the same area where the property is going for $75 a square meter. So we can actually use that valuation to value that. So what is the value of the land within this particular property? And you're also told that the size of the property is 10,000 square meters. And let me just put full 10 million here. Right. Then we say land. The land that we have here is valued at, so it's 10,000 square meters times $75. So we can actually establish that the value of the land within the property is 750,000, which means the remaining is the building as well as the infrastructure. We are also told that at the same time that the road, that there is a road there which is quite extensive, but the key aspect here, which I want to draw your attention to, is that we are told that it would cost 2 million to construct the road today, but the road is not being constructed today. It was constructed 5 years ago, which means we can't say the value of the road is 2 million. We need to depreciate the 2 million to get to say what is the value of that road today. So we're going to say the road. Yeah, I'm just going to ignore. I know I'll illustrate differently the change in residual values. That's not my focus here. So I'm just going to focus and ignore residual values for the sake of simplicity. So 2 million was 5 years ago. If you go to the Zimbabwe Financial Reporting Manual, tarred roads have got a useful life of 30 years. So here we've already done 5 years out of the 30. So we're going to use a depreciated replacement cost for this particular road. So it becomes 2 million times, in terms of the remaining years, divided by 30. Right, so the value for a road is 1.6 million in this case, by just using a depreciated replacement cost there. So what will be our journal entries? So we are going to debit. So here we then need to find what is the value of the, just before I do the journal entries, what is the value of the building? So it's now 10 million minus the value of the land minus the value of the road. So the value of the building is 7.5 million. So I'm going to debit. So remember, this is a reclassification because I already had this property as a building in my books, but now we're just reclassifying elements of that property into land and also into the road. So the building, right, then I'm going to debit the building with that 7.5. And then I also have got the road, which is 1.6 million. And then I also have got the land, which is 750,000. And then lastly, I then credit the current land and building, which was one class, right? Which is 10 million. So in first time adoption, this is sort of like how we deal with the reclassification, where we have to move assets from one class into different classes because of the IPSAS and and also because of the changes that brought about by Zimbabwe Financial Reporting Manual. So that is our first example that we have here. We'll do questions at the end. So allow me to move on to the next example. The next example that we want to look at is where recognition of an asset which was not previously recognized. So we didn't have this asset in our books previously, but now that we've applied IPSAS, we realize that it's important that we bring this asset in the books. So construction works on roads for the city of Mutare was not capitalized in the books, as this was done directly by the Ministry of Transport. The value of the construction works is 20 million. So the assumption here is that IPSAS says, and if the issue is not recognition, this is a road that belongs to Mutare City Council, but the construction works was done maybe through the ministry. And then we had not capitalized this in our books previously, using our previous reporting framework. But now as we're implementing IPSAS, we realize that we should capitalize all the works because then those works should be capitalized within the road. They meet the eligibility criteria. So what am I going to do? I'm going to debit my road to bring it on board, and the value is 20 what? The value is 20 million. And then I'm going to credit my non-distributable reserve, which is how much? Which is 20 million. So please note, if previously I was already on IPSAS, this would have come through and let's say this happened like 2 years ago, this would have come through as a correction of a prior period error. But because we're implementing IPSAS for the first time, we are saying there is a difference. IPSAS says this is an asset which you must recognize, so it's going to non-distributable reserve here. So all resulting adjustments like we got from that slide is that they go through a component of equity. So we're using the non-distributable reserve to bring these construction works into the road. So that is the second example, which I wanted to demonstrate on an asset that was not previously recognized. Now let's look at the third example that I also want to demonstrate is recognition of an asset with different useful life and residual values. So here I'm using again another example. MTT as a motor vehicle that cost 20 million. Current depreciation policy is to depreciate motor vehicles over 10 years with no residual value. The motor vehicle was bought on 1 January 2022 and is expected useful life of 5 years. Okay, so please take note here. Number one, we are saying our previous policy, we're depreciating this car over 5 years and with no residual value. But with the Zimbabwe financial reporting coming on board, two things have happened. The ZFRM says motor vehicles are depreciated over 5 years. So we need to revise that estimate, okay? So that's number one, from 10 years to 5 years. The second thing as well is previously we didn't have any residual value, but because of the ZFRM, we now have to introduce a residual value, which is 1% of the cost of this motor vehicle. So it's something that we're not doing, but we now have to do. So I just want to illustrate again through journal entries and calculations how you then adjust for this motor vehicle as you bring it, as you correct it in your books. Now, the first assumption I'm going to make is that you're doing this on 1 January, let's say 2024, okay? So you're doing this on one, remember, all these are part of implementation. So you've got 3 standards to begin to, to implement this. So you were not able to do it on 1 January 2023, and we're now doing it on 1 January 2024. We're still within the transitional period. So the first thing we need to do is to calculate the carrying amount of the motor vehicle on 1 January 2024. And we said it was bought on, so the carrying amount, the motor vehicle was bought on 1 January 2022, so it is done 2022, 2023. So it has already done 2 years of the 10 years. So which means it's got 8 years remaining. So you're saying 20 million times 8 over 10, which is the remaining useful life. So currently in our books, the motor vehicle is currently sitting with a carrying amount of 16 million. Right. So on 1 January 2024, we now want to implement the new provisions, particularly related to the Zimbabwe Financial Reporting Manual, where we need to, let me just put the cost here, which is 20. Right. So we want to bring in so here, let me just also add, so accumulated depreciation, so that we just have got all the figures there. So accumulated depreciation is 20 minus what? Minus 16. So these are the numbers we have before we start doing these changes. So what do we need to do? Number one, this is a change in estimate. And the standard says if it's a change in estimate, you adjust for the changes prospectively, not retrospectively, which means we are not going to adjust our carrying amount on 1 January 2024. The carrying amount remains 16 million. What is going to change is the rate of depreciation for 2024. So this change is going to be prospective. We adjust for it going into future what? Into future periods. So let's look at how that would then happen. So I'm going to say let's look at what is the depreciation for 2024. I think that's where the change is because it's prospective. 16 million doesn't change. So I'm going to say 16 million. So I'm going to say the depreciation, it's 16 million. Yes, 16 million is my current divided by what is now the remaining useful life, right? The remaining useful life, as you're seeing, initially it was 8, right? Initially it was, we had the total useful life of 10, we've done 2 years. So the remaining useful life is 8. But now we are adjusting the remaining useful life because we're saying it's supposed to have been 5. We've already done 2. So we are now saying the remaining useful life is actually now 3 years. So this is what we're going to do. So you're going to say, I've done open bracket here, the carrying amount minus the residual value, which is 1%. And residual value is on cost, not on carrying amount. So I'm going to take this 20 million and I multiply by 1%, which is the residual value. And I said this divided by 3 years. So my depreciation becomes 5.2 million. Let me explain again in case you missed something here. We have 10 years. Initially, we're depreciating this motor vehicle over 10 years. We've already done 2 years on the date we are doing this correction. But now we are told that motor vehicles should be depreciated over 5 years. So we are now saying the remaining useful life of this motor vehicle is now 3 years. okay, because we've already done 2. So that's the first change. That's why here I'm now dividing by 3. It's 5 years minus 3. Secondly, I'm also introducing that the ZFRM says all assets should be a residual value of 1%. So I'm now introducing 1%, but remember the 1% is on cost, so it's still on 20 million. So that's why I've then said the carrying amount 16 million minus 1% of 20 million, then divided by 3 years to get my depreciation for 2024, which means my net book value or carrying amount, some people use different net book value or carrying amount at the end of December is now 16 million minus 5 million, which is now 10 million. And going forward, I'm now depreciating it on that, using that rate going forward. So that's sort of the demonstration. This change again, it's very cross-cutting because it's going to affect a lot of people, particularly those that are moving from IFRS or were already on some kind of an accrual before, even those that were on IPSAS before this new change. Why? Because what it does is that, particularly the 1%, a lot of people were not depreciating to the residual value, and some had different useful lives. So I believe it's going to be cross-cutting. Then the last example that I want to then look at is to do with recognition of asset with a different useful life and residual value, but past the useful life. So let's look at, so here we've got Ministry of Finance as a motor vehicle bought on 1 January 2017. The cost of a new similar car on 31 December 2024 is 20 million, right? So this example is very interesting. Why? Because because it was bought in 2017 and we'll probably expense the cost as you're doing and we can't find those records. So what have we done? We've gone onto the market and said, a new motor vehicle of this make, how much does it cost? And we're told it costs 20 million. So what it means is, in order to calculate my carrying amount today, I want to use a depreciated replacement cost, okay? Which means I must take 20 million and depreciate it to get my value to date, like what we did with this other in the previous example. But take note, 2017, 2018, 2019, 2021, 2022, the 5 years in which you depreciate motor vehicle has already lapsed, right? Because we are now in 2024. So what do I do? Because now if I depreciate it, the depreciation is already what? The useful life has already lapsed. So what do I do? That's what. So we'll have a lot of these assets because some of the assets that we're trying to bring into IPSAS are past the useful life already. So the question that I want to address is, what do you do with those assets? So that's what this example is, just trying to illustrate and demonstrate. So what do we do? The long and short of it is that all assets which are past useful life would be recognized at what? At the residual value. So this is how you would do the calculation. So I'm going to say it's the cost of a new similar asset today is 20 million, right? It's 20 million. So let's calculate what is the accumulated depreciation. What is the accumulated depreciation? So accumulated depreciation is 20 million, which is the cost minus 1% of 1% times 20 million divided by 5 years, okay? Right, so this was my annual depreciation for each year, right? But remember, I've already done, so if I then count the years, so this will be annual, so this will be annual depreciation, okay? Now, accumulated depreciation, right? Accumulated depreciation. If I count the years from 2017 to 2024, that's like 7 years. So I must limit my accumulated, to 5 years, which is the useful life. So I'm going to multiply this times 5, okay? Then I get it's 19,800. So that's my accumulated depreciation. Remember, you can't multiply this by 7. Because why? Because you can only limit it to the useful life, which is 5 years. So which means my net book value or my carrying amount slash net book value is 20 million minus the accumulated depreciation, which is 200,000, which is essentially 1%, which is the residual value. So this allows us to comply with the requirements of the Zimbabwe Financial Reporting Manual that ensures that if an asset is fully depreciated, it must sit at this residual value. Once it gets to residual value, you stop depreciating. You can only write down an asset below the residual value as a result of, number one, impairment or on derecognition. So those are the two instances where you're going to write down your asset below the residual value. So this is just some illustratives that I just wanted to do, just illustrating just a couple of examples on changes in accounting policy and in accounting estimates. So I'm going to hand over you back to Wilma, who is also just going to run some things and also introduce Joseph, who then take us through on accounting for revaluations as well as accounting for separate components. Thank you very much. Over to you, Wilma.
Thank you very much, Alice. That was quite informative. So I'll just also like to announce that we'll take questions after the whole session, after Joseph's session. So for now, I'll also like to let you know about the products that we currently have on offer on workshops, IPSAS related. So if you want to learn more about these IPSAS standards, please do come through. We've got 2 workshops which are running in Kadoma, one for the practical handholding workshop on preparing 2024 IPSAS compliant financial statements, which is running for 3 days. And this workshop basically aims to equip participants with comprehensive understanding of the IPSAS framework and its application in Zimbabwe, and more with the ZFRM that Alice has alluded on. So with this workshop, there'll be practical case studies, exercises, and real-life examples that participants will gain hands-on experience in preparing the 2024 financial statements. So this workshop is for 3 days in Kadoma at the Kadoma Rainbow Hotel. So we've got various packages for those with conferencing only, for those who want with accommodation, and also a bonus for those who want with a digital corporate tablet. So this tablet is loaded with the standards that you would require on your day-to-day basis. So for this, I also share the flyers on the chat platform. Then for the other conference, the other workshop is for auditors. So this one was specializing with the auditors for them to enhance their understanding of IPSAS, its benefits, its challenges, and its implementation as well. They'll also be able to learn about how to validate financial statements and develop strategies for ensuring IPSAS compliance through internal audit. So the auditors one is running for 5 days from 10th of February to 14th of February. So this one is a 5-day conference for internal auditors. And the one for practical handholding is a 3-day workshop. I'll also share further details on the chat platform. So with this moment, I'd also like to introduce to you our second speaker, who is Mr. Joseph Chimwanda. So Mr. Joseph Chimwanda is a public sector professional accountant. As maybe most of you are aware, we also offer the public sector professional accountant program, which is a 3-year program in collaboration with IPSAS. So Joseph is one of the pioneers who actually managed to successfully pass these examinations. So yes, it's doable. For those also who are also inspiring to come to BPSPA, this is also a platform. He's also an ACA member with more than 20 years experience, mainly spent in the public sector. Joseph has also experience in developing and updating training material on financial reporting, and also for public sector clients, facilitating training and capacity building. So Joseph has held various positions in internal audit, administration, financial management, and also in central government, parastatals, and NGOs. So Joseph is also well equipped to be also explaining to you about the IPSAS 45. So over to you, Joseph.
Thank you, Wilma. Good morning, everyone. I'm welcoming you to our second part of this webinar. We were, exploring IPSAS 45, just looking at the key issues. I would facilitate on 2 aspects of the standard, which is basically accounting for revaluation of assets, and also for accounting for components. There are some PPE items that have got significant components whose depreciation might have to be calculated separately. So let me share my screen. Please confirm you are seeing my screen.
Confirmed.
Confirmed.
Thank you so much. Right. When we talk of revaluations are a measurement issue. Remember, we've got a standard that deals with measurement of assets, which is our IPSAS 46. We're not going to get into IPSAS 46 itself, but we're just going to focus on how we account for the revaluations. So, when it comes to measurement of assets, our PP allows us to, initially we measure our assets at cost, except those that are acquired through a non-exchange transaction, in which case they are measured at fair value. But generally, those that are acquired in exchange transactions, we measure them initially at cost when we initially recognize those assets in our books. Then when it comes to measurement after initial recognition, so we then have got IPSAS 45 giving us two options, which is the current value model. Some people call it the revaluation model, but in terms of our terminology in the public sector, we talk of the current value model, and also the historical cost basis or the historical cost model. Now, while the standard gives us those two options in our measurement, subsequent measurement of our PP assets, it is important to draw attention to the requirements of the Zimbabwe Financial Reporting Manual, which has already made selections for all of us in the public sector to say, for land, for buildings, and for infrastructure assets, you are going to carry them subsequently under the revaluation model or the current value model. But then for all other PPI items other than those three that have itemized, you are then required to carry them under the historical cost model. So it's important to point out at the onset to say, while the standard gives you those two options, you've already been, there's a matter of policy. I think the Minister of Finance has already given us direction through the FRM. Right. So when you talk of historical cost model, we are simply saying, I'm going to carry my asset at cost less any accumulated depreciation and any accumulated impairment losses. When I'm carrying my assets under the current value model, say for land, for buildings, and for infrastructure assets, I'll carry the assets at revalued amount less any subsequent accumulated depreciation and any subsequent accumulated impairment losses. So from the date of the last revaluation, you are saying I'm carrying my asset at that previous revalued amount less accumulated depreciation up to date of reporting. That's the clarification on the two subsequent measurement approaches. Now, how do we then account for the revaluations? So when you revalue, generally you find that your assets normally go up. So if your asset or PP item, if the value of the asset goes up, then you normally credit directly that revaluation surplus to a revaluation surplus account, which is a balance sheet item, which is a statement of financial position item. So what it simply means is that you debit your PPE with the upward movement in the value of the asset, and you credit your revaluation reserve, which is a balance sheet item under equity, right? Then, however, it should if you have previously revalued this amount, this asset, if your previous revaluation, if your previous revaluation had a decrease in the value of the asset, then any increase that you have had in your current valuation must then be taken through surplus and deficit. As an example, say previously you had an asset that had a carrying amount of 20 million ZiG. Then you do a valuation, say, and then you find the value is at what? At 18 million ZiG. This is a decrease in value as a result of the revaluation activity. So that 2 million decrease or difference between the current carrying amount of 20 and the revalued amount of 18 is taken through directly to the statement of surplus and deficit. In the private sector, they call it the profit and loss. So that decrease will be taken through as an expense, which is a decrease in value as a result of the revaluation. Then if in a subsequent revaluation, you then have the asset going up to say 25 million. Now the figure is now going up from the previous valuation. So the valuation is now up. So the movement upwards, to the extent that it reverses the previous decrease in valuation, it must be taken through the statement of surplus and deficit. It's like a gain on revaluation. But then the excess of that is then going through directly to equity again. I'm sure I'm clear then. If it's not clear, then you're going to, you can ask you can then give us a query, we can give an example. So that's when you've got an increase in valuation, you are saying you're taking through directly through the revaluation surplus, the revaluation reserve, unless the revaluation upwards, the upward movement in value is a reversal of a previous decrease in value following another valuation, in which case it then goes through surplus and deficit. So similarly, if you had a revaluation reserve, an amount is sitting in revaluation reserve for a particular class of assets, and then in your subsequent revaluation, you find that the asset is in your valuation, the asset has gone down. The decrease is debited directly to the revaluation surplus, which is an equity account. But you credit the amount to, you can credit the amount to surplus and deficit if the revaluation is reversing a previous decrease in what? In the value of the asset. So that's how you treat the revaluation gains and losses. Right, now how do we then do the accounting for the revaluation? I've already indicated that when the value goes up, it means you pass your journal entry, which debits your PPE item and you credit your revaluation surplus. If you've got an upward review of the value following the activity. So what happens to accumulated depreciation for a revalued asset? Right. Let me just do this. Right. If an item of PP is revalued, any accumulated depreciation at the date of the valuation is either restated proportionately with the change in the gross carrying amount of the asset, or you can eliminate the accumulated depreciation against the gross carrying amount of the asset. Then the net amount, you eliminate against the gross carrying amount of the asset, and the net amount restated to the revalued amount of the asset. So we're saying the net amount is actually your carrying amount, which is sitting in your balance sheet. So it's the carrying amount which is actually increasing by the revalued amount, by the difference between the carrying amount and the valuation. So just to give you in terms of figures, I have an example here where there's a machine that costs 5 million in our books. It's sitting in our books at a cost of 5 million. Remember, in our financial records, the machine remains measured at cost. And then it has an accumulated depreciation of 2 million, and that leaves us a carrying amount of 3 million. So on date of revaluation, say the valuer say this asset is now worth 6 million. It means your carrying amount should increase from 3 million to 6 million. So how do you do that? What we're then going to have is we need to remember we've got an accumulated depreciation of what? Of 2 million in our books. So we need to eliminate that accumulated depreciation against what? the revaluation. So we're going to have, you credit your revaluation reserve with 3 million. This is to account for the increase in what? In the carrying amount of the asset. Then you debit your PPE with 1 million, debit accumulated depreciation with what? With 2 million. When you debit your PPE with 1 million, what does it do? It increases your cost of the machine in your records to 6 million. So positive, it says increased the cost of a machine to 6 million, and now we have knocked off your 2 million accumulated depreciation. So on date of revaluation, the accumulated depreciation is now sitting at 0. So the cost of the asset is now up to 6 million, and the cost in the carrying amount on date of revaluation are equal. So we have already taken up your asset value from a carrying amount of 3 million to a carrying amount of 6 million. And in the process, you have also realized, you now have got recognized a what? A revaluation, an increase of 3 million to a revaluation reserve. So your equity has gone up by the amount of the revaluation. Because the value have said your asset is at 3 million carrying amount currently, but we see that the value is now at what? 6 million. So this is, so that journal entry is showing you the mechanics of actually doing it in the accounts. How do you put through these adjustments so that in your balance sheet at that reporting date, you now have got your machine sitting at 6 million in the balance sheet. So it has gone up by 3 million, which is the amount by which your revaluation reserve has gone up. And the cost of the asset going forward, we're going to be depreciating based on what? 6 million. Because the machine was sitting at 5 million cost, we've increased that cost by 1 million to 6, which is the carrying amount on date of revaluation. Right, then that is about revaluations. Just wanted to, the key issues there is about how we account for it, for that movement. Then we're now looking at accounting for separate components. I think you realize that if you, especially for your infrastructure assets, you have got, normally these are, composed of various components, which have got different useful lives. And so, and normally they've got, that the components are replaced at different intervals, but they are all part of the same infrastructure asset that we want to recognize. In the books, we've got what? Our infrastructure asset, maybe it's a water treatment plant for arrested cancer. It can sit there as an item, infrastructure asset, under infrastructure asset is a what? Is a water treatment plant. But that plant is made up of several components, each of which can be accounted for separately. So in terms of, so this is what we are saying to say there are some parts of items of PPE that may require replacement at regular intervals. So significant components of PPE may be accounted for separately. For example, your elevator in a building can be accounted for separately. You may also look at things like your air conditioning systems could be part of the building, but they've got different lifespan to the building. So they can be also accounted for separately in terms of computing your depreciation for that building. Although you can they are part of the building, but we need to have a component approach to depreciation calculation, because the air conditioning equipment might have a lifespan of 10 years or 5 years, and yet the building has got a lifespan of 60 years. So we then need to provide to have in terms of separate workings for depreciation, to say my depreciation for air conditioning systems is over 5 years straight line. The other item, maybe the elevator is 10 years or 15 years life, straight line. Then the whole building, I'm depreciating over what? 60 years. You can't then use the lifespan of the building as the basis on which to calculate depreciation for all the other components whose lifespans are different from that of the main asset. So when such parts or components are replaced, the carrying amount of the replaced component must be de-recognized. Take it out of your books. But it means you take out cost, you take out the accumulated depreciation, then that effectively takes out the carrying amount of the component that is being replaced. Then the cost of the replacement component must be capitalized. You de-recognize the replaced component, and then you capitalize the replacement component. So each part of an item of PPE with a cost that is significant in relation to the total cost shall be depreciated what? Separately, which is what I've already indicated. So let's look at, before I look at an example of depreciation, let's look at the Zimbabwe Financial Reporting Manual considerations for buildings. Here we are saying what items could be regarded as separate items from the building. What items could be considered to be components of the building itself. So upon installation of the item, the question, you need to ask ourselves these questions. If the item, if the intention is to eventually remove and reuse the item, then the item is classified as machinery and equipment. So you are saying, is the intention to eventually remove and reuse the item is part of the, it looks like it's part of our building. But if our intention is to eventually remove it and use it separately, then that item is not part of the building. It's not a component of the building. We then treat it as what? As machinery and equipment. This is the guideline from what? From the ZFRM. If the item cannot be removed from the building without causing significant damage to the building or to the item, then the item is part of a component of the building. Because we are saying, if I can't remove it without causing significant damage to the building or to the item itself, then that part is just considered to be a component of the building. So I can then use the component approach that I've talked about in terms of accounting for it, accounting for its depreciation over its own expected useful life, which is distinct from the useful life of the building. So if the item is typically found in a building and typically included as part of the original construction, your doors, your plumbing fixtures, and general purpose lighting, then they are part of the building. They're only, if their material is significant, they can be components. Especially when some of them, initially, you may not recognize them separately, but should there be any replacement of a major component, that's the point that you then want to separate and say, how I now need to estimate the carrying amount of the item that I'm replacing and capitalize the component that I'm bringing in as a replacement. If the cost of removal exceeds the cost or value of the item, then the item is part of the building. We would rather not obviously remove it. The cost of removal exceeds the cost or value of the item. And if once removed, if the item is typically reinstalled in another building, then that item is not part of the building. It's just what? Machinery and equipment. So I hope it's that guidance from the Zimbabwe Financial Reporting Manual helps us when it comes to our assets such as buildings, so that we are able to see which significant components could we consider to be part of the building and which components are considered to be separate items, which are machinery and equipment. Right, then this depreciation example is there to illustrate the component approach. What we have here is you've got a water treatment facility with those components. There's a building structure whose cost is 2 million and an expected useful life of 40 years. Then we've got a roof, whose cost is 500,000 and the expected useful life of 15 years. You've got pumps with a cost of 1 million and the expected useful life of 10 years. Then we've got the heating, ventilation, and air conditioning system with a cost of 500,000 and expected useful life of 15 years. So assuming that the facility was in service from 1 January 2023, assuming that's the year in which, the date on which this unit facility came into use, and that there's no residual value, and then also we are using straight line depreciation method. What is depreciation for the year ended 31 December 2023? So like I've said, if it's a company, these companies with different useful lives. So we're assuming straight line depreciation and no residual value. So for the building, we're going to say, if you look at this working, you are now saying, I'm dividing the cost by the useful life, assuming there's no residual value. But remember, in your case, you need to go back to the Zimbabwe Financial Reporting Manual, which then says, as a matter of policy, government is saying, we are going to assume a residual value of 1%. So you are going to take down out the residual value of 1% of the cost, and then you depreciate the depreciable amount over the useful life of the asset. In which case, you'd say 2 million less 1%, then the depreciable amount is 99% of 2 million, divided that by 40 to then get the annual depreciation of, in this case, I've just assumed there's a new residual value. So mine will be depreciation of 50,000. But yours, as you take into account the 1% residual value in your ZFRM, your figure there will be different. So your roof, you're saying the cost over 15 years, assuming a new residual value, that's the depreciation of 33,333. Same applies to the pumps, cost over the useful life of 10 years. So that's what, sorry, it's supposed to be 100,000. So I made a mistake here. So it's 1 million divided by 10, and then get 100,000, yeah? Right, then the HVAC system, you divide that cost by 15, you get that annual depreciation figure. So this total amount there of 1,116,666, that amount is then going to go to the main worksheet for depreciation to say, under water treatment facility, I've got my annual depreciation is actually 1,116,000. But I've got a working to it, which is this spreadsheet, which shows me that I'm accounting for depreciation separately for each major component, because each component is a different useful life to the whole structure. So that's all I have to share with you on accounting for revaluations and accounting for components of your PPE. Thank you. So I hand over you to Wilma.
Thank you so much, Joseph. That was quite informative. So I'm sure all of you have got some questions. You need more information. So that's why we're saying, please do come to Kadoma for these interactive workshops. There'll be practical sessions where you can actually come and get assistance from our facilitators who will be there throughout the week for both the auditors workshop and the financial statements preparation one. So in the chat platform, I've also put in the links for all those who want to register, either for the financial statements preparation one or the audit workshop. So please do take note, those are the two different workshops but happening concurrently in Kadoma. Then we're also available on our WhatsApp platform, or you can actually make phone calls if you intend to get more information. If you need any quotations, if you need any assistance or any consultations, we are here to help you. We are here to assist you make this transition as seamless as possible that it can be. Then also we're on our social media platforms. Please follow us on our Facebook, on our LinkedIn, on our Instagram, and also subscribe to our WhatsApp e-channel where we'll be posting all upcoming webinars, also YouTube videos that we also tend to share time and again. So please do get in touch and follow us to always stay informed and ahead of these IPSAS standards. So I'd like to see you all in Kadoma. Then also for those who want further information, please do get in touch. The dates are 10 to 14 February for the auditor's session. Then for the practical handholding for IPSAS financial statements is 10 to 12 February. And there are various packages as well. For all those who need information, I'll definitely be here and ready to assist you. So without taking much of your time, I'd like to open this platform for all questions. I think we've seen some posting on the chat platform. So our facilitators maybe would start by answering those ones. Then anyone else, you're free either to raise your hand or to type in for us to be able to assist you. So I don't know, maybe Joseph, you would like to take over the first questions in the chat platform? Joseph or Alice? The first one reads, we had assets which on revaluation model, how do we proceed?
Okay. Now it depends on what assets, what assets they had on this valuation model. Remember, the Zimbabwe Financial Reporting Manual is saying for anything other than land, buildings, and infrastructure assets, you're going to be using the cost model. So for assets that are supposed to be on cost model under the new framework, this will be obviously an accounting policy change to say for those ones, there's going to be a change from revaluation to historical cost basis. Then for land, buildings, and infrastructure assets, they just continue the way they've been accounting for them because there's no change in policy there. That's my issue. I'm sure Ellis touched on how they account for changes in accounting policy to say they need to apply the change retrospectively. I'm not sure whether I've answered the question. Are they answered?
I think we'll see on the chat platform. The other question was, we have motor vehicles and furniture for over 20 years. How do you treat those?
Right, so it says, thank you for the detailed explanation on vehicle depreciation. My question is, you've got motor vehicles and furniture for over 20. How do we treat those? I want to combine this question with another question that I got, which says also, I have assets with zero balances and would like to have them at 1%. What are the journals? Right, so regardless of, so the first thing that you must do is, number one, if you've got an asset, if you go to the ZFRIM, there is guidance about 1%. There is also the aspect of the useful life, which is there. So what it means is if your furniture is over 20 years and the ZFRM says you depreciate, let's say over 10 years or 15 years, that furniture is already past its useful life. So it must therefore sit in your books at the residual value, which is the 1%. And now there is, in terms of the guidance, if you do valuation for those assets, like you saw in that other example, we use the cost of a vehicle. It's a valuation technique we recommend. You value your assets using, let's say it's a desk. If I was going to buy the new desk today, how much? And then you establish how much. And 1% of that becomes your residual value. And that's what you're now going to use to recognize that asset. And then the other question was saying, what are the journals if the assets were already sitting at zero balance? So the journals here is, it depends. If you're coming from cash, I'm assuming that they've got zero balance because maybe you're already on IFRS. So now you're moving to IPSAS and you want to keep them at 1%. So the option you have is, once you know what that 1% is, which I've covered in the previous question, in terms of writing it back, you can write it back by debiting your accumulated depreciation. So the assumption is, if your asset had a cost of 5,000, your accumulated depreciation is now 5,000. That's how you now have got zero. So when you've now calculated the 1%, what do? You go back and you debit your accumulated depreciation, which means you are reversing accumulated depreciation to the tune of 1%, which means now when you're now reporting, it's now cost, and then there's an accumulated depreciation, and then the remaining balance becomes equivalent to 1%. And that would be my recommendation in terms of how you do it. Then there's another question which came into my direct inbox, which says, my value of building is only for building. It did not take into account land value. Therefore, cannot separate land value and building value. How do I go about it? So the question is, where did you get this value? Ordinarily, if the land is not yours, then it's okay because you can't account for something that is not yours. You just account for the building. But let's say the property is yours. When you do a valuation, there's likelihood that the valuer might say this is the value of the building, but they're actually talking about the building, both the building and the land. So just be very careful there, because most of the time we say this is my building, but what you're saying essentially is the land and the building are my asset. So when the value is, say it is 20 million, in most instances, it's not just the building excluding the land. Sometimes it's actually both the land and the building. So you must split that. But if you are certain that it's just the building, then you might actually then do evaluation of the land on which it is owned separately. That is, if the land meets the recognition criteria in terms of you have control over that land. So I hope that that sort of helps you there. What will be the useful life for revalued asset? The useful life doesn't change unless you've got reason or evidence to believe that the useful life has changed. So for example, if I revalue a building, in the ZFRM we use between 60 to 80 years of a building, right? Let's say there's remaining 40 years on a building and I revalue that asset. I'm not going to depreciate the revalued amount over the remaining, which is 40 years. So unless you've got evidence that the useful life has either increased or decreased, which is a separate matter altogether, revaluation does not necessarily trigger the need to change the useful life. So you just then depreciate the revalued amount over the remaining useful life. Right. I think, right, the last question I have is, how do we treat assets to cost information where cost information is not available, not the dates of acquisition? So number one, if you don't have any cost information, the best way to go is to value those assets. If you don't know when they were acquired, the next best thing is to actually estimate based on available evidence. So you can just use estimation. The standard allows us to use estimations, right? Right. Wilma, back to you. Are we taking, I know we are behind time, but I see there's a raised hand. Maybe we can take one question. Yes, Makuyana here, but you can go ahead.
Okay, thank you, Ellis. I think my questions also relate to assets that have been revalued, where you were using the revaluation model. Now we're trying to transition to the IPSAS framework. So in terms of calculation of the 1% residual value, where are we basing it on in the event that I can't find my cost? Can I use the last fair value amount or revalued amount to estimate my 1% residual value?
Yes, you can, but I need to just explain so that, because it's very important how you do it. So the principle is the 1% is not calculated on the revalued amount. It's calculated on cost. So the principle remains. If I don't have the cost, I'm going to use that last revaluation as a deemed cost, which I then use for my asset going forward. So what it means is, if it's 2 million, is then 1% of 2 million. Now, if in the following year I do a revaluation, I don't change that 1% of 2 million, because I was using that last revaluation as the deemed cost. So any future revaluations, I'm now, because the mistake that others then make is they now keep changing their 1% and now basing it on the most recent valuation. So it still needs to remain on that revaluation that you used as a deemed cost. I hope that helps there.
Okay, then the other question is on the issue of the residual amount. You said assets that have been fully depreciated are carried at the residual amount. But if the asset are still in use, does the standard allows us to give it more life, like in the previous reporting framework, where we would assess the useful life of the assets at every financial year end?
Right. So if already your assets are at revalued amount, so at residual value. So okay, let's separate these things. The standard allows you to reassess the remaining useful life every year. So this you must do. So it can either increase useful life or reduce it. That's fair and fine. Now, let's say your assets are now depreciated and they're now sitting on the residual value. So it doesn't matter whether you increase the useful life or not, because you can't depreciate them below the residual value. So it's not going to have, so changing the useful life of those assets, because normally when you change the useful life of assets, it impacts on your depreciation that you charge for that particular year. But in this case, because you're already on residual value, we've stopped depreciating, it's not going to have any effect. The only time you're going to write the assets below the residual value is either through impairment or through derecognition. So whether you revise or not, it's not going to have any effect because it's just going to stay on that amount. Yeah. Anyaradzo?
Hello?
Yes, go ahead.
Hello? All right, ours is not a question. It was just a request. We are from the local authorities. So the moment we get invites straight from you guys, our bosses, they don't understand it. They want something from the ministry. So is it possible for you guys to engage the Ministry of Local Government so that the invite comes from them so that you'll be able to attend the workshops?
Yes. Thank you very much. We're actually in the process of doing that. Takes a bit of time.
All right.
So hopefully in future workshops, we are working on a framework where we can really work with them. But yes,
It's
we've
all
started
right.
those engagements. Yeah. Thank you.
Thank you. All right.
All right. Right, Wilma, back to you.
All right, thank you so much, Alice. And I'd like to take this opportunity to thank you. Quite very informative and I'm not. Hello, can you hear me?
Yes, we can.
All right, it's fine. So I was saying that I'd like to thank everyone for taking the time to attend this session, and we do appreciate all your questions. Please do keep them coming, like on all our platforms with the social media.